Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal studios. Instead of three, there are two today because the third one is at the Morgan conference, that is Surabhi. Nigel, good morning.
Well, morning, Prashant. We get to the market action, but just a word on the IPL Championship yesterday. RCB, 18 long years, Virat Kohli going in there, kissing the eagle or the cup, so to call it. And yeah, that was pure joy, right? Yeah. 18 years, loyalty, gave his all. Says that till the last day he plays IPL, he'll be playing for the Royal Challengers as well. So kudos to the team, a team performance, and Krunal Pandya, what a brilliant spell in the finals.
No, absolutely, and I think we'll talk about it as we go along through the course of the day. But absolutely fantastic, 18 long years, as Nigel said. But those are iconic images, and each one of them will never forget it. I think really. Outstanding performance, and I think a well-deserved win by the end of it. A well-deserved title by the end of it. All right, let's just come back to the market very quickly because we've got stuff happening as always as far as markets go. And I think we'll have a special guest joining us from the Morgan conference in a bit from now. But maybe we'll have a minute or so before we get to it. So quickly, right? I mean, last night the close was higher. S&P was up about 0.6%. The Nasdaq was up about 1%. The Russell 2000 was up about 1.5%. So these are positive closes, good closes. Nothing happened on yields. Dollar was up about 0.5%. Oil prices 1.5% higher. We're at about $66 or so. There is a lot of news flow. Actually, not news flow, not actual stuff happening. Some, but mostly commentary. So Trump signed the order hiking steel and aluminum tariffs to 50%. Let's move the graphics along. This has now finally happened. I mean, of course, it's well telegraphed, but the 50% hike in aluminum and steel tariffs has happened. WSJ wrote, there was a piece which essentially said, according to sources, China is prepared to play hardball with the US, and they're not willing to sort of lay down and get rolled over. Howard Lutnick, and this is a comment which we will play out, and I think we did yesterday, but this is almost 24 hours back, but he said very optimistic that a trade deal with India is coming soon. That's another one in terms of trade-related stuff. But I think what's got a lot of people watching this very carefully is commentary from Elon Musk. And he's blasted the Trump bill as abomination. You know, that's a strong word to use. And many will look at signals. Trump has not responded yet. But how he responds, whether this is the first sort of, in a way, a bit of a crack really between, the two very strong sort of, the top two really in terms of influence over the Republican Party in that sense. So we'll see how this one goes. But he's called it a spendthrift abomination. Another bit on trade, USTR has sent letters to countries to give their best offers on trade by Wednesday. And they're saying, well, send it to us. It was, the White House press secretary was asked about it at the press conference. She said, well, we send these letters as a polite reminder to countries that the tariff deadline is coming. So let's just work before, let's just get something done before that. She also kind of emphasized, without giving a time, etc., that Trump and President Xi of China will talk very soon. So this is the news flow and a fair bit happening, a lot up in the air as always. I'll just sort of tie in the levels here. Nifty yesterday closed below the 20-day moving average. It was, of course, a bit of a cut. It came off the lows, though. But we are in a broader range. And the broader range is basically 24,462 on the downside and 25,116 on the upside. And the markets found it very difficult to break either the upside or the downside levels. So on the way down, support 24,462. Below that, the 40-day exponential average is for 24,309. And then, of course, for the Nifty Bank, which failed to see any follow-through buying yesterday, the 20-day is at 55,163, which is the important support level. Swing highs, recent swing highs, as we pointed out, will remain the resistance zone. So I think that's the broad setup as we are looking at it. We'll get to the futures and options bit and, of course, the setup there with Nigel in just a bit from now. But let me just throw it across to Surabhi and Nimesh, who are joining us from the sidelines of the Morgan Stanley's annual India Investment Forum with a special guest with them. Guys, good morning.
Good morning, Prashant and Nigel. You absolutely said it right. Special guest, and special because he's probably one of the biggest, if not the biggest bull on the India story, when it's whether it's macros or whether it's the market. Rhythm Desai of Morgan Stanley. Here we are on day 2 of the Morgan Stanley conference, and Rhythm is as excited and charged up as ever. Pleasure to have you here with us, Rhythm. So tell us, how's the Josh at the conference and otherwise?
Yeah, no, the Josh is high. There's a lot of interest in India, except that it doesn't actually convert into flows, which we'll come to later in this conversation. But yeah, there's a lot of interest. There's no doubt that people need to understand India from multiple angles. See, I'll tell you how these things have changed. We've been doing this for 27 years. Yeah. So many years ago, people would come because they had portfolios or they were looking to buy stocks in India. And they had to check on companies and understand the macro. That has now changed to the extent that, of course, that people do that for a living and they have to do it. But they also need to understand India from a global perspective. Yeah. So you're not now just coming to India because you have a couple of investments in India. You're also coming to India because India is moving the world. You know, as I've recently said, the world may not slip into recession this year because of India. Now, it's important to know whether India is going to do well or not, because if India is not going to do well, then the world may have a recession, which is going to have implications on everyone else. So I think India's stature in global markets and in global macro has completely changed in the last 10 years. And we're now significant, we're important. People need to understand this country, even if they don't have investments here. So that is the change.
Is that something that you're observing in terms of the clients that come for the conferences? In the last many years, some new investors coming in, even though they are not registered or whatever they're looking to register, a lot of newer FIs are looking across geographies to come and visit India and understand the India story.
Actually, Nimesh, that's not restricted to just equity clients, even corporations.
Okay.
And if I look at the last 2 years, I've probably met as many corporate CEOs as I've met CIOs. Okay. Because CEOs are also examining India, and I think there's actually a lot greater interest in the corporate world than there is in the equity world. And the reason for that is that the equity markets are still not easy for
get into India market,
for what I call as tourist money.
Yeah, yeah.
If you are an entrenched investor with ample resources to understand the market, then you have got yourself registered, etc. But if you are just passing by, like you're a tourist, right? Now, if you're a tourist, then it is not like you can just arrive this morning and trade the stocks, right? You have to go through a process. And that is where tourist money struggles to actually engage. Corporates actually come with a longer duration on the table, so they have a lot of time and they need to understand India. And I've been saying this now, that depending on what product or service you sell to your customers, India is somewhere between 10% to 150% of your growth in the next 2 calendar years. So that is as simple as is. If you're growing your business, India is accounting for most of it. India this year will be nearly a quarter of global GDP growth, and probably the same next year. So this is not the same India that we used to chat about many years ago. It's a very different India.
So before we talk, the usual earnings, valuations, and the market targets, just describe to us India's place in this new world, at least for the next 3.5, 4 years, till we have the present US dispensation in place. There's a lot of talk about whether India can, quote-unquote, seize this opportunity as a dislocation in global supply chains. Do you see that happening? I mean, industrial is a sector that, for instance, you're overweight on. What does this new Trump order, global order, mean for Indian companies? And then, therefore, we'll talk about their stock prices.
See, Surbhi, the decision on setting up a local manufacturing facility in India, I don't think has much to do with the tariffs that President Trump is proposing. A lot of these plans were already underway pre-April, and I don't think are changing dramatically because of the tariffs. There may be some delays because people want to have clarity, and that is exactly why global growth is slowing down. Because companies are pushing back on their investment plans, just waiting to see how the environment pans out in the next few months. That aside, there is really no impact on these investment plans. India is still a favored destination for what we call as China +1. And one of the primary drivers for that is what I mentioned earlier, that India's home market is very critical to a lot of multinational corporations. You look at the industrial companies from Europe, and they're all telling you that India is going to be a big driver of their growth. You look at the electronics sector, look at phone companies, India is a major part of their growth, and likewise. So that has not changed on April 2nd. So that story is continuing, and India will continue to attract. That said, one thing which we need to bear in mind is India is not becoming the next China. I don't think the world has appetite to create capacities like it did in China in the last 20 years. The unfortunate thing is that the world is heavily indebted and is aging. And therefore, growth on a structural basis for the world at large, ex-India, is likely to be a whole lot slower than it has been in the last, say, 15 or 20 years. And therefore, the appetite to build large capacities is not there. But the appetite to diversify supply chains, the appetite to build facilities in India to cater to India's home market, that's clearly there. Okay. So India's manufacturing share of GDP will rise, but you should not be holding your breath for the next China. It's not happening, in my view.
Which is fine. Take your point on that. Then let's talk about earnings. And I think in your latest review, you do speak about how, because of a confluence of a lot of positive factors, you're expecting on a sustained basis, mid to maybe even high teens earnings growth. And I think that's a little above consensus, going by other estimates on the street. What makes you confident that earnings are coming back?
I'm never confident. I'm always skeptical. but we are in an earnings upcycle. Very simply put, earnings tend to move around the nominal GDP trend. The nominal GDP trend in India is largely a straight line, except for the COVID dip when things turn a little bit bad. But that's those rare things that happen. And earnings, of course, do this. So earnings don't go up in a straight line, and we are somewhere here right now. Trend line GDP is here. Okay. So this damage happened between 2011 and 2015. Earnings fell well below trend. And now we are playing catch up. And then again, we got a bit of a setback during COVID, and now we're playing catch up. So the likelihood is, and it's very simple mathematics, earnings will catch up with nominal GDP and then go above it. And then that will be the peak of the cycle. I think we're somewhere halfway through that cycle.
We're still away from that peak.
Yeah, we're somewhere halfway. We consider the COVID bottom as the start of this earnings cycle, though I do think the earnings cycle started slightly before that, but COVID has distorted the data. So we are somewhere halfway through that, and it is largely driven by a slow and steady rise in capex. And the reason why this cycle looks more durable than the previous one, which was from 2004 to 2008, is that capex is not going to go up like this. So in that cycle, what happened is capex went up like this and then came down, right? So earnings also went up like this and came down. This time it's more good. I think it's more likely to be like this. Also, a lot of people are saying, oh, there's no capex in India. The reason I think they feel that way is because the nature of capital spending has changed. Yeah. We're not going to now build the massive steel and cement plants that we saw in that era. Again, a lot of the capex is being written off on the balance sheets. It's not been actually capitalized because that's the nature of capex. And most importantly, in the last 10 years, there's a technical term called incremental capital output ratio, which is how much capital do I need to create 1 unit of output. That amount has actually fallen because India has become more productive. Labor productivity has gone up, and in fact, all factor productivity is higher. Our infrastructure is better, our labor is better, and all of that essentially means we need lesser capex to drive the same amount of growth. Okay, so got the point. Basically, there's no more point crying, saying that private sector capex is not picking up, animal spirits are not firing. We need to go beneath the surface to see the reality, perhaps. There is some element of animal spirits, and I think they did get dampened last year. Because last year, remember, the government contracted its fiscal deficit a lot, especially in the first half of last fiscal. We arrived in the end of September, the fiscal deficit was tracking 3.4% of GDP versus 6 in the previous year. That's not the type of fiscal consolidation any economy can take. There were one-off factors. It started normalizing. It took about 3 months to normalize, and now we have arrived in this year, and the first quarter was very good. Now, added to that is the fact that the central bank has become far more dovish, rightfully so, and that is, I think, fueling a recovery from that soft patch that we went through, which I think triggered the small mid-cap sell-off. And really, I tell this to people. Now just think about it. What has happened in the last 6 months? You've had a precipitous sell-off in small and mid-caps. Some stocks went down 70-80%. We had this, major announcements on tariff. We had a little bit of a skirmish with Pakistan. And we had this slowdown in growth, which everybody thought was the end of this cycle. So imagine we digested all of this, and the market is like 4-5% from all-time highs. So my instinct is, technically, the market wants to go up. It doesn't want to go down. So, you are bearish at your own risk. I carry a little bit of a red flag here to warn the bears.
So, Rhythm, you spoke about, market wants to go up, and you highlight a lot of things. The other factor has been the technical factor of supply of paper. We've seen massive blocks and massive promoter and PE exits in the last few weeks. How do you read that developments, and is that a red flag according to you?
So, Nimesh, 2 things I'll say. Is that most people thought that if the mid-cap index fell 20-25%, retail will run away.
Yeah.
So first of all, let us accept that retail is not a short-term player. And if you talk to people, really large distributors on the ground, and you should interview some of these people because they have a far better
pulse on
handle on the retail sentiment than the people who are actually managing the money.
Yeah.
Okay. So they will tell you that retail in India is not looking at their prices every day. They're not your audience.
Yes.
They're buying the stocks and just going to sleep.
Yeah.
Okay. And that's, the average holding period, I've done this computation, of Indian retail investors is 36 months.
Yeah.
Nowhere on the planet do any class of investors hold stocks that long as the average investor in India holds.
And I remember you saying this for many years now, that the retail money is very sticky and it's only going to surprise on the upside.
Yes, so that is done. Okay, now as far as supply is concerned, yes, we had a little bit of bunching up, but that was in 2023. Okay, there was a bit of a bunching up that happened. And then things
Even
eased.
now we are seeing this, 4-5 deals every day.
But you have to add up the numbers and you have to divide it by the market cap.
Sure.
So whatever number you see, whether it's a weekly or a monthly number, if it's a monthly number, multiply it by 12 and divide it by market.
Yeah, sure.
That number, if it starts crossing 2.5-3%,
Okay.
then I will get worried. What is 2.5-3%? It's $10 billion of issuance every month for 9 to 10 months on the trot.
Oh.
We're not there as yet.
You're not there, of course.
We are going to get there, but we're not there. When we get there, the market will have to correct, because I think that will then exceed the bid on stocks.
I'm going to come back to that first point that you made, right? And you asked that question before we could, which is that when are these foreign investors coming? Because the narrative is strong, the macros are strong. And there's this big shift about diversifying away from US assets, right? Yeah. But where will we figure? Because China is a great competitor, and maybe the argument is they have valuations on their side.
So the China valuations have always been on the Chinese side for 25 years. There's not been a single year in the last 25 that China traded at a premium to Indian X stocks. Okay? Yet, in the last 25 years, India has handsomely beaten Chinese stocks. So if you invest in stocks looking at P ratios, it's a disaster.
Yeah.
Price to earnings has nothing to do with value.
Is that what you're telling the foreign clients?
No, I'll explain this to you. Give me a little minute. Give me a little time. So price to earnings is just another way of expressing price. You can express price in US dollars. I can say this is worth $6. Then I can say it's like worth half a gram of gold. I mean, its price. Its price is 500 rupees, or its price is 5 times earnings. Value is something very different. It's about a company's ability to generate cash flows and what expected return I have from that. So the reason I can't explain this is because a lot of the tourist money is also very lazy. and wants convenient thumb rules to make their decisions. And very wrong. Okay, you look at private sector banks in India 25 years ago. They all traded significantly higher price-to multiples than today. Yet for 20 years, they were amongst the best performing stocks in India.
Yeah.
If the starting point of price to book or price to earnings is going to determine what return you make, then I think then investing would be a very easy game.
Yes.
So it's not so simple. In my humble opinion, and it's not even humble, I think stocks are cheap. Okay. Stocks are inexpensive in India. I wrote that day before yesterday. My title of my report is Equities are inexpensive. Bond yield in India, 10-year bond yield is 6.2%. The equity yield is 5%. India is a growth market. The gap is -1%. This is cheap.
Yeah.
Look at Nifty in gold ounces. Either gold prices fall or Nifty goes up. It's cheap.
That's refreshing. Indian stocks are cheap. We don't hear that every day. So to complete...
So the reason I'm saying that is because as a consequence of the policy decisions that we have made in the last few years, we have dampened our inflation volatility, which therefore means we have dampened our interest rate walls. And if interest rate walls are low, growth walls are low.
Yeah.
Equities thrive in a predictable growth environment. If you can figure that a company has a 20% CAGR in growth for the next 5 years, you will pay 60 times earnings for it.
Yeah.
You're not going to say, oh, 60 is expensive, because predictability of earnings or predictability of dividends, to be more precise, is the trickiest thing in equities. It's not the issue in bonds. In bonds, you know the coupon and you know it exactly for how many years. So there's no valuation debate in bonds. The debate arises not only because of this, that your forecast and my forecast on cash flows is different.
Now that's
justifying the bull.
That's the India bull, turning the valuation argument on its head, and that tells me why.
It's logical as well.
It's not about turning it. This is not a spin. This is the fundamental reality.
This is perhaps a different lens.
Now see, I can go wrong on my cash flow forecast. And that's why I will go wrong on stocks, not because they're trading at 20 times earnings.
Yeah, that explains why the 1 lakh target on the sensex is intact, the bull case. All right, Rhythm, fantastic conversation. Thank you so much for taking out the time and being with us this morning. With that, we take a quick break and then we come back to more cues on the market.
Welcome back. Hope you're having a good morning. Well, let's take a quick check on how our trade setup is looking with regard to the F&O market. I was looking at a couple of indicators, technical indicators, and in fact, the RSI on the Nifty, that had ballooned up to more than 65, that's cooled off to around 50. That's more or less at neutral territory. I believe that today, in fact, may be a good day to buy the dip. And I think it could be a good trading session for the bulls. Let me explain why. We ended down 170 points yesterday, but the India VIX as well cooled off. That sometimes is the comforting factor from a bullish perspective. Next up, the FIs, they've been adding shorts. They're adding shorts actually very aggressively. So in yesterday's trading session, they added 13,000 short contracts. On index futures, even on stock futures, close to around 30,000 contracts is what they've added. And just pull up a chart. Last few trading sessions, they were net short. From around 70,000 contracts, now they're holding at around 1 lakh net short contracts. This market is looking for a positive trigger. If that's the case, they're going to get stumped on the wrong side. And that's the hope actually that's playing out. And also, if you look at it in percentage terms, the FIs on index futures is getting to the higher end of the range at around 83% or thereabouts. Clients, they're doing the exact opposite of what the FIs are doing. They added longs in yesterday's trading session, both on index futures as well as on stock futures. So both of them on the opposite end. So the VIX cooling off, FI is net short, and throw in there the PCR coming into at the lower end of the range at around 0.64 or thereabouts. All these three technical indicators, they're telling us that maybe today is a good day to buy the dip and participate on the long side. And why has the PCR come down? Because the called writers, they've been writing aggressively. 24,600, 24,700 calls. Between them, close to around 80 lakh shares getting added out there. But there is some writing at around the 24,500, 24,550 put, which brings us to the level. Just for the day, 24,420, that's the level in terms of a support level. While resistance, the bears believe they are going to defend this 24,800, 24,850. So we'll keep an eye out on that. The Nifty Bank, the first reference point you have is at the 20 DMA. For the last many trading sessions, gets to 56,000, not able to conquer that. But by the end of today, you'll want to defend the 20 DMA. So as I said earlier, wearing a shade of green, maybe in fact today is the day that you want to participate on the upside and you want to buy the dip. That said, Prashant, let's get straight to the stocks, though, for the day.
Absolutely. And so that's essentially the trade setup, the cues to watch as we start another trading session. Let's get our research team in now as the top 10 stocks to focus on. Ola Electric and Yes Bank are the first ones we want to sort of highlight. Nimish, it's back to you.
Thanks, Prashant. So, both Ola and Yes Bank, we did report yesterday that, the identities on who are the sellers. I'll start with Ola first. So Hyundai was a seller in Ola Electric. They did it at a discount and the stock ended lower. But there was a confirmation that Hyundai and Kia, they both sold a little over 3% stake in Ola Electric. And but there was no confirmation on the buyers list. But I understand some funds have bought in yesterday's block deal. So that was Ola. The second important deal was Yes Bank. The stock ended almost 10% lower after the large block. And then there was a confirmation as well in the evening that Carlyle indeed sold 3% stake at a discount, and that's the reason why the stock ended lower. For Yes Bank, there could be a further supply overhang because Carlyle still owns, after even selling 3%, they own a little over 3.5% stake in Yes Bank. And there is one more large private equity investor, Advent, who owns 10% stake. So the supply overhang could be there in Yes Bank in the near term, and hence that stock ended lower and could be under pressure in today's market as well. So these were the two large blocks which got executed yesterday.
Okay, all right, Nimesh. Thanks a lot. We'll keep an eye out on those stocks. Well, that said, let's hop across to Ritu because there could be some more paper that's coming in there. HBD Financial getting the green signal. Ritu, tell us, HDFC Bank is the stock in focus.
Yes, Nigel, HDFC Bank is going to be in focus because SEBI has finally greenlit that much anticipated 12,500 crore rupee IPO of its subsidiary HDB Financial Services, and that will mark the largest IPO by any NBFC in recent times and the first HDFC Group company to go public in nearly 7 years. The IPO itself is a mix of about 2,500 crores of a fresh issue and importantly 10,000 crores offer for sale by the parent HDFC Bank, which currently holds more than 94% stake in the company. Although even after the IPO, HDB will continue to remain a subsidiary of HDFC Bank. Now, the listing is not just strategic, it is very much regulatory because HDB, keep in mind, has been classified as an upper layer NBFC by RBI, and that mandates a public listing by September this year.
All right, Ritu, thanks a lot for that. And there's going to be a party in Bangalore today. Once the team comes back with the cup, I'm sure, Ritu, you're going to be dancing on the streets?
Well, Nigel, there's been a party all night long.
Wow.
I mean, some of us found it really hard to sleep.
All right. I was surprised that you're up so early, Ritu, but HBD Financial is important as well. Thanks a lot, Ritu, for giving us that. And I'll get on to a chat with you and ask you how the celebrations are progressing. But let's get back to Nimish. Nimish, AB Fashion and Alchem Labs, you hinted there could be larger trades. Bang on. Tell us more.
So, Nigel, yesterday we saw 4 large blocks. Today there are going to be 4 large blocks. I'll cover 2 of them, Alchem Labs and AB Fashion. In Alchem Labs, the promoter is looking to sell close to 1.5% stake via block deal. The offer price is at a 3% discount to yesterday's closing price. So, my sense is that maybe the deal will happen in the block window and the promoter will raise close to 825 crores approximately. So that's one sizable deal. The other one is AB Fashion and Retail. This is going to be interesting. Flipkart is selling its entire 6% stake in AB Fashion and Retail. Remember, this is the demerged entity. The other part has to still list. There the discount is quite steep at 7% discount. So the floor price is 80 bucks. And as I said, they're going to sell their entire 6% stake and raise close to 600 crores. So I'll go with marginal green for Alchem because it might happen in the block window. But we'll go with red because of the dip discount in AB Fashion.
All right, no, absolutely. Blocks galore, Nimesh, right? And I think a lot happening and more coming. Let's talk about Indegene and Tata Technologies. Vivek has got details on both. Vivek, morning.
Well, good morning. Continuing with the trend of block deals that Nimesh just highlighted, 2 more large blocks on offer today, and both of these blocks are actually clean out trades. So that's something to keep in mind. So the first one that we're discussing is Indegene. It's a very large block. So Carlyle, one of the early pre-IPO PE investors, is completely exiting its stake from Indegene. A 10.2% equity is what they're looking to sell. The floor price is at 580 rupees a share, 6.4 discount to yesterday's close. So the size of the block will be in excess of 1,400 crore rupees. The other stock on the radar is Tata Technologies. Now, this is interesting. The seller here is TPG Rise. So now they are left with close to 2.1% of the total equity that they are completely exiting. Interestingly, remember at the end of the March quarter, they held a little over 6% stake, which they have been paring down since April. So post this particular block deal, TPG Rise will not have any stake in the company. So that's another stock to keep on the radar. The floor price is at the 3% discount and the size of the block is slightly over 630 crore rupees.
Okay, all right. Thanks a lot for that, Vivek. Well, let's go to Ekta then. She's here to tell us about Sun Pharma. Ekta?
Thanks for that. Well, yes, Sun Pharma is in focus because they've announced the top-line results of a particular molecule which is under development for them, phase 2 trials of SCD-044. It is basically being studied for psoriasis and atopic dermatitis. The drug has not met primary endpoints in either of the two studies, that is for psoriasis as well as for dermatitis, and hence the development is being discontinued. No further clinical trials are planned. Sun Pharma and Spark will also be in focus on account of this, will assess the next steps for the compound. It is obviously a negative because the street was looking at this particular molecule quite closely and was considered to be one of the key assets in Sun Pharma's pipeline, and obviously Spark would be involved because of the manufacturing part of it. Expect red for both these stocks.
All right, Ekta, thanks very much. NMDC Techno Electric next. Vamakshi, good morning.
Prashant, let me first start off with NMDC. The counter is expected to open in the red, and that is because they've cut the lump ore prices as well as the fines prices. They've gone ahead and cut the lump ore price by 140 rupees per ton, bringing it to now 6,300 rupees per ton. As far as fines is concerned, they've cut the price out here by 150 rupees per ton, bringing it to 5,350 rupees per ton. Keep in mind that just a month ago, they had gone ahead and hiked the prices in both iron ore lump as well as fine by almost 440 rupees per ton. So therefore, this cut coming through soon enough, going with the red for this counter. But apart from that, keep an eye out on Techno Electric as well, going with the green because the company has been selected by RailTel as managed service data center partner through the open tender process on revenue sharing basis. They've gone ahead and signed a 30-year contract. They will be setting up a 10 megawatt data center in phases on RailTel land in Noida. The overall execution period for this project is 1.5 to 3 years and will be executed in two phases of almost 5 megawatts each. So therefore, given this development, going with the green for this counter.
All right, Vamakshi, on that point on NMDC, you all probed the management yesterday with regard to that cut because of the change in formula, and bang on 24 hours later, we see that price cut that comes about. Thanks a lot for joining in. Well, let's do a quick recap of all the top stocks we covered, the ones with positive news flow. Alchem, HDFC Bank, Techno Electric. On the flip side, you have more number of stocks that will be reacting to negative news flow. They include Aditya Birla Fashion, Indegene, Tata Tech, Ola Electric, Yes Bank, Sun Pharma, and NMDC. Turning attention away from the equity markets, then Manisha Gupta joins us to tell us what's going on in the commodity markets. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with gold and silver because we've seen a rebound come in for both of these. Remember, we are looking at safe haven buying, one from the geopolitical side of it, and then there are slowdown concerns as well. The Chinese economic data coming in on the weaker side clearly has led to safe haven buying here. And then the markets also are looking at the decline in US dollar index. That's keeping the prices higher. All of these markets also are cautious ahead of the potential call between Trump and Xi Jinping. Of course, the date and time is not known, but there are expectations that it could happen this week itself. And then it also is about the U.S. non-farm payroll data that's on Friday. That will also tell you on whether or not we are looking at the first Fed rate interest cut coming in the month of September or not. That is what the markets really seem to be betting on at this point in time. I quickly want to touch upon metals as well, barring copper, which is seeing some gains. Everything else, including steel, iron ore, aluminum, nickel, are trading at multi-week to multi-month lows at this point in time. Pressure from China and, of course, the U.S. tariff increase, all of that weighing onto the sector.
Okay, all right, Manisha. Thanks a lot for joining and giving us a quick update. For the time being, we slip into a short break. Come back. We'll get to some fundamental analysis. Devin Choksey of DR Choksey FinServ is waiting by.
Welcome back. I think we just quickly look at the gift nifty and see what that is doing before we go further. 50 points still on the gift nifty at this point in time. Now, from the sidelines of the BofA Securities 2025 India Conference, my colleague Nimesh caught up with Anand Swaminathan. He's senior analyst, India and ASEAN banks at BofA Securities. He began by asking Anand why BofA is positive on mid-sized private banks and their view on PSU banks as well. Listen in.
We are broadly positive on the sector where we are right now. We are at an interesting juncture for the overall sector as well. We are at the start of a very good easing cycle from the regulator. We are at the turn of a growth cycle as well. And we are in the middle of a lot of geopolitics and a lot of tensions there as well. But what we see in India is where investor positioning is, where valuations are for the Indian banks. We do think the risk reward for the overall sector still remains pretty good. We see selective pockets of value across the spectrum, across big cap banks, mid cap banks, and the government banks as well. And especially in a rate cut cycle, we started liking a bit more of the mid cap banks, which benefit more in a rate cut cycle.
Sure. I actually wanted to ask you on that. So we have a policy coming up. There is a lot of hope of maybe it'll surprise with a 50 basis point rate cut. But in general, in a cutting rate cycle, you spoke about smaller banks benefiting most. But what's your broad thesis on whether the small banks do well or the PSUs bank do well?
Sure. I think, Nimesh, the overall question is eventually do we get better growth or not?
Yeah.
At the outset, lower rates do kind of hit bank margins to begin with. But eventually you will see the mid-cap banks who are structured more like NBFCs in terms of asset and liability, eventually benefiting in terms of NIMs. And that is what is driving our benefit or preference for the mid-cap banks in the next 6 to 12-month period. But overall, with all these efforts and better liquidity from RBI, we need to see that translate into better macro growth, better credit growth. That will eventually drive the stocks and performance in our view.
I'll ask you about the credit growth and the asset quality as well. But first, a word on the PSU bank stocks. We've seen a bit of recovery in the PSU banks as well. And as you've been writing off late, there are a lot of others who've highlighted that the performance of PSU banks have been pretty good. And that's why you're seeing a bit of bridge getting, bridged. The gap is getting bridged with the valuations on PSU banks. What's your take on PSU banks? And are you all bullish on that?
Yeah. We've been positive on PSU banks for more than 2 years now, Nimesh. We see two things. One, from a structural, how they are operating, risk management, what they focus on. There is a meaningful change in how these banks operate. And that takes time to show up in numbers. Number two, in terms of their own intent to grow and defend their market share, we are clearly seeing that in numbers. And the loss in market share is significantly narrowed. That is also showing up in numbers. I think in the short term, what has driven that kind of move in the last month or so is a very low investor positioning and where valuations are. And if you see the valuation gap between the private banks and government banks, which had again widened meaningfully to historic highs, I think that is what partly is driving this short-term rally in these names.
Sure. But, if I want to ask you about how to value the PSU banks now. Historically, we've been taught it's easy to buy PSU banks at 0.5 time book and to sell around 1 time price to book. Yeah. Now, most of the PSU banks are trading around 0.95 to 1 time price to book. Is that going to change dramatically in terms of higher valuation for the PSU banks going forward?
Yeah. It's an interesting question, Nimesh. It depends on sustainability of how they deliver numbers. Right now, if you look at forward book numbers, they are trading at around 0.8 times and around 6 times, 7 times PE. If you compare that to private banks, they're almost twice that multiple. I think what we are going to see is next few quarters, next couple of years, as the market realizes that the asset quality improvements are real, we do think some of that kind of valuation re-rating can happen. We do think majority of the government banks can deliver around a 1 to 1.1% ROA on a sustainable basis. That would end up being a 1 to 1.2 times price to book and around 8-9 times PE. And more importantly, these banks now grow their book value at 13-14% a year, which means every year your valuations get more interesting. And that's what I think gives you better risk reward in these names even now.
You spoke briefly about asset quality, and the big question mark on asset quality has been for the MFIs, And that seems to be largely getting priced in the stock prices. Yeah. But in terms of real asset quality concerns, do you think the worst is behind and from here on, you're going to see improvement in the MFI book?
Yeah, we met a lot of banks in our conference as well. I think what is clear is the worst is behind us. That's good news. What we need to see is how fast is the normalization process. The June quarter typically is a weak quarter for the macro, and seasonally not much happens. So probably the improvement in June quarter will be gradual, but we do expect from the September-December quarters things to improve meaningfully from asset quality perspective. And when that happens, we will see growth and dispersals pick up much faster as well in this segment.
The other big thing was we recently had an accident, so to speak, with IndusInd Bank, the regulator going down heavily, and then there was a large loss as well. Yeah. How should investor approach the mid-sized banks? Given that what happened to IndusInd Bank, and you are a bullish on a few of those mid-cap banks as well. What should be the investor approach?
I think we need to take these cases one by one. We cannot extrapolate and make a broader sector view on that. I think what is true definitely is in the last cycle, 7-8 years, the regulatory approach and oversight has significantly improved. And with technology, a lot of things have come under control. And I would say generally also from an investor perspective, the governance perception for Indian banks has meaningfully improved. I think we should just look at this as one case and not extrapolate it to the broader sector. I think the key thing here is RBI is on the watch, and we have an overall ecosystem and governance structure which keeps things pretty much in control.
So for the second half, we want to ask you, given that there are going to be rate cuts, given that there will be some stimulus as well from what the government has announced, what are the key things to watch out for from a banking perspective, especially from a private bank perspective?
Yeah, I think what we are tracking, first of all, is the demand drivers. Right? So that's finally the most important thing to drive credit growth. Unfortunately, we are not seeing that many positive signs as of yet. It could be seasonality as well, because June quarter is seasonally weak. We would look for any signs of improvements in consumer sentiment, any signs of improvement in corporate capex sentiment. I think it's a matter of time, given the risk appetite is there from the banks to lend. And finally, liquidity was a big problem for the last couple of years. It's getting fixed as well. So from that perspective, I think all the pieces are fitting into place. I would say it's a matter of time we start seeing growth improving.
So then, before I let you go, what would be a pecking order, say, between MFI, between small private banks and large private banks? What would be a pecking order?
As I said, we do like across the spectrum specific names, but we do think as a play on the rate cut cycle, we recently turned a bit more positive on the mid-cap names, which will eventually see benefits from rate cuts. They did see a lot of pressure on their NIMs over the last 2-3 years because of tight liquidity and all that. I think all that reversing will eventually improve, and there should also be a better beta play on the eventual macro recovery in India as well.
Well, interesting views there with regard to BofA Securities. They believe that risk reward is still favorable for a lot of the banking names. For the time being, though, we slipped into a short break. As promised, Deven Choksi is waiting for us. He'll help us out with some fundamental analysis. Welcome back. You're tuned in to Bazaar Morning Call here on CNBC-TV18. Deven Choksi joins us on the show. Hi, Deven. Good morning. Good to see you. And as always, let's talk about the big boy, HDFC Bank. It's pulled back in the last few months after underperforming for a longer duration. What's your view on the stock from here on? You got a bit of a green signal coming in from regulators with regard to HDB Financial's nod for an IPO, which will help them raise some money. But, how big a trigger is it for the stock? And your view on this big name?
Good morning. Well, on the fundamental merit side, I think that things are looking pretty set as far as I think both HDFC Bank and HDB Financial is concerned. HDB Financial is largely, I think, catering to the MSME segment as well as I think the individual segment of loans in the NBFC bracket. Whereas I think HDFC Bank, I think, is a composite mixture of I think all of their portfolios. So I think on a point of view of looking at the complementary strength that it could bring post-listing, could be on one or two counts. Importantly, I think the money which is getting released from offer for sale, which is about 10,000 crores, would probably help HDFC Bank in a way to probably expand their business, which is, I think, a significant because their growth rate is somewhere around 17-18% on even at this point of time, or maybe 19%. And similar situation could be with HDB Financials. I think they get a chance to expand their books, which probably I think they remain little compromised when you compare with Bajaj Finance. I think this institution deserves to be, I think, going in the same territory. So it has possibly not moved as much as I think Bajaj Finance has. And with this listing, I think there is a good possibility that they would get a better opportunity to capitalize themselves in this situation. So yes, I think for immediate benefit, HDFC Bank will reflect the valuations of HDB Financials at the same time. So we remain distinctly positive. Maybe some part of the price movement has already happened for HDFC Bank. I think with this IPO clearing, I think the price will probably go up from here.
Okay, all right. Devin, I wanted to ask you about a couple of large trades. Mr. Sinha will be selling stake in Alchem Labs. So, that's one large trade we're looking forward to. The other one is ABFRL because Flipkart is going to be selling 6% in the company. Your view on either of these names?
Anything in particular for both these companies, Nigel, at this point of time. But I think one important point, with the hands changing, we are likely to see, I think, the stronger performance coming from these companies because the new investors, in particular, I think, are likely to be a little bit more assertive as far as I think ABFRL is concerned. So maybe I think I'm relatively more positive on prospect side than to talk about anything on the fundamentals at this point of time.
Devin, hi, morning. Yesterday, how is the market itself looking to you? Finally, are we breaking out of this range? 24, 450 or so on the downside, 25, 100 on the upside. For a brief while, it looked like yesterday the market wanted to... we did dip. We are below the 20-day on the Nifty. What's your sense, Devin?
Yeah, Prashant. Morning. Well, I believe that after the fourth quarter result season is over, I think the hands are changing. Maybe the rotations are happening. Some of the typical small cap stocks where institution holding, including the mutual funds, who have been finding them on a valuation heavy side, they have been seen selling some of these stocks and generating the cash, putting that money into some of the Nifty 50 large cap companies as we have seen. And that's what I think I have been observing, that the hands are changing from small cap, mid cap companies which are expensive to some of the large cap companies which are relatively less expensive but having higher amount of growth certainty, particularly in a period wherein we are seeing FY25-26 registering higher amount of growth. So this is a typical behavior that we are observing right now in the market, and as a result of which we are seeing the stock prices are also remaining slightly corrected from 25,000 plus level to whatever I think yesterday Nifty was around 24,500 kind of. So maybe I think the corrections may probably get little deeper and maybe 24,250, 24,100 kind of levels. If that comes for the market, then some of the banking stocks, some of the metal stocks, even the promoter groups like Adani Group stocks, you might possibly find the new buying emerging into this kind of businesses with the price correction taking place in this particular period. But yes, one thing is certain, most of the companies are looking really set for higher growth, even after listening to the earning commentaries. I believe that I think we are seeing largely higher growth in this financial year 25-26. And that's where you're going to see the buying actions happening in many of these companies.
Devin, I wanted your view on Tata Technologies. I recall what a blockbuster listing it was. There was so much of interest. I think 1,200 rupees was the stock price, if I remember correctly. Today, the stock is sub 800. You have TPG that will be selling some stake in today's trading session. What's your view on this name? A stock that people fancied at 1,000 rupees plus is today available at less than 800 and possibly available at 750 today because it could happen at a bit of a discount, the large trade. Your view on this name, and if you don't have a view on this, then what do you prepare from the tech pack?
So I think we like this company, and I think it's a fantastic opportunity, if you ask me, because I think very few companies would have developed this kind of capability, wherein they would cater to verticals like automobile, they would cater to verticals like aviation, and even for that matter, machinery segment in the industry. I think the aviation and the auto segment, both verticals on which they are catering to end-to-end solution, starting from picking up the design trend and delivering the last mile in form of the vehicles going into the service center. The entire spectrum of activity being carried out by this company and has been demonstrated in the joint venture with BMW. I believe that I think this particular company has miles to go. Probably this is the last overhang which we are seeing as far as I think the exit of a large investor is concerned. With this exit completing, in my viewpoint, I think the stock should find the re-rating. And fundamentals are remaining absolutely strong as I see it. Both Tata Technology and in a way even Tata Elxsi. I think the tie-up with Mercedes-Benz that they have done in Tata Elxsi, and this company has done a tie-up with BMW. We see a larger part of the business they are cornering from the European OEM side. And that's where I believe that I think the growth opportunity could be big. In fact, I think the size of the market that they are both address, particularly Tata Technology, I believe that I think registering $1 to $1.5 billion worth of revenue book over a period of I think 3-4 years from now, I think is distinctly possible for this company. So I remain distinctly positive about the prospects going forward.
Okay, Devin, thank you very much for that. Appreciate it very much here. Shorter conversation, but always useful. Thank you. We'll take a quick commercial break here. We come back with technicals in focus. Sudarshan and Mitesh on the other side. Stay tuned. Okay, welcome back. There's 3 minutes to go for the pre-open session and a little bit more for the actual open as well. But I think we'll get a quick sense on prices in about 5 or 6 minutes once the pre-open settles. Sudarshan and Mitesh are with us with what they'd want you to do as we open up for today's session. Gentlemen, good morning. Great to have both of you here. Mitesh, how are things looking? Yesterday, we got a bit of a dip, and I was asking Devin earlier, this range, 24,450 to about 25,100. Are we likely to break it, or the market likely to remain in this range?
Yeah. So, good morning, Prashant. I have been calling for consolidation, but now is the time, when you have some signs that possibly the range might be willing to break on the upside. The idea is very simple, that, the PCR has dropped down to levels of below 0.5, 0.55. I mean, it's hovering around those levels. So I think that's the range. That's the PCR area, where typically you will see short-term bottoms being made. And therefore, I think, now that we're at lower end of the range, I think one, long trades could be taken. Two, I think, there could be a chance that we might not only head towards the upper end of the range, but also this time try and break it. So that's the kind of outlook we have. So therefore, trading with more of positive bias. And as I said, I think the downside of the range is around 24,500, 24,460. So if somebody is wanting to take long positions, I think a good idea would be to explore longs with a stop just below levels of 24,420.
Got it. Okay, all right. Got that view, Mitesh. Sounding a little bit more optimistic on trade today. Sudarshan, what about you?
Yeah, good morning. See, the Nifty is in a trading range. Now, within a trading range, intraday moves are almost unpredictable because that's the nature of the range, that the market doesn't know where it wants to go. So on days, sometimes it tries to go up, sometimes it tries to go down, and sometimes both on any given day. So we have to look at a bigger picture. The bigger picture is this. The lower end of the range, 24,500 approximately, is holding. Now it is holding after repeated attempts to break it down. That tells us that at the lower end of the range, there is a buying opportunity. Now 24,500 is our stop loss. If that breaks, then that opportunity comes to an end, and that's okay. We have to accept that. But if it doesn't break, then there is a possibility of a rally at least to the top of the range, which is about 25,000. So currently the trade is to be long with a stop at 24,500.
Okay, all right. Be long. That's the call coming in from both Mitesh and Sudarshan, but watchful. Sudarshan, morning. What would you do in terms of specific stocks?
Interesting part, there are no short selling signals coming. They are in the mid caps and small caps, only buy ideas are emerging. PEL is a buy with a stop under 1115. United Spirits is a buying opportunity, stop under 1545. CUB, City Union Bank is a buy with a stop under 197. And SRF is a buying opportunity with a stop under 2890. There are a variety of buy options which I'm explaining every day in small and mid cap. So something is going on there.
Okay, all right. Sounding quite upbeat even about individual stocks. Got that, Sudarshan. Mitesh, what about you?
Morning, Nigel. I also have more of buy calls today. There's one sell call as well, though. On the buying side is Glenmark with a stop at 1497 for targets of 1550. Oberoi Realty is a buy with a stop at 1774 for targets of 1840. And Hindustan Zinc is a buy with a stop at 459 for targets of 490. And Voltas is on the sell side, 1245 being the stop. Look for targets of around 1190 on the downside.
Okay, all right. Got that. Thanks a lot for that, gentlemen. Well, let's focus on Tata Motors. The company has unveiled its electric SUV Harrier EV at a starting price of around 21 lakh rupees. The car is estimated to offer 480 to 505 kilometer drive on a single charge. The company is also offering a lifetime warranty on the battery pack. Speaking to CNBC-TV18, the company's MD, Mr. Sailesh Chandra, said that the automaker plans to keep its EV market share at around 50% in the mid to the long-term period, and says that there will be no disruption due to China's rare earth magnet curve. Let's listen in.
Frankly, from Tata Motors' perspective, there's no immediate disruption that I see. I would be wrong in saying that we don't have dependence on this. There is dependence. As SIAM president, SIAM as well as ACMA both are very closely interacting with the government. Government has been very supportive on this issue, in terms of reaching out to the Chinese government also, the relevant ministries there. And we hope that the issue might be, taken care of or addressed very soon. Market share was supposed to fall. We were 85%, 75%. Good that we are losing market share.
But now down to almost 50.
Yeah, which is okay. And that is my steady state mid to long term market share ambition is 50%. Globally, the best players in a market, in a healthy market, is about 25%. The market leader, I'm saying. We have ambition of keeping 50% because the concentration and brand consideration is very high towards a market leader brand. And therefore, 50% is what we have from a mid to long term strategy.
Okay, and so that's important. No immediate impact because of the rare earth magnet curve out of China. And it's an issue which the industry is watching very, very closely. Some have said that maybe 2-3 months is essentially what the inventory companies have. And after that, it becomes a bit of a problem. It's not, of course, just an issue for Indian auto industry, but globally as well. Now, let's just focus on another space, right? The oil and gas sector. The government has cut the APM gas prices after 2 years, giving a boost to city gas distribution companies. Let's get some more perspective on this. Prabal Sen is energy analyst at ICICI Securities, who's with us. Prabal, good morning. Great to have you with us here. Thank you for your time. What is, Prabal, your revised F526, F527 gas cost assumption for city gas companies post the APM gas cut?
Honestly, we've at this point looked at it as a scenario, because if you look at it, the price scenario keeps continuously changing. And obviously, this decision is a little bit of a positive and has a 4 to 5% annualized impact on the EPS if it lasts for the full year. So obviously, that's something that we'll observe closely as we go along in terms of where the crude price actually lands up at. At the end of the day now, from a discussion where the cap of 6.5 and now 6.75 was considered to be vulnerable to crude price spikes, we have come to a situation where prices could go even lower. And I would argue that if it was not for the geopolitical risk of the Russia-Ukraine conflict, you would probably see prices, crude prices going down even lower, but that's not the case, and that's not likely to be the case given where we are. So I think it's a little bit fluid. Directionally, obviously, the fact that the government is proactively changing prices in line with the way crude prices are behaving, and when you couple that with the fact that LNG prices also look, vulnerable to supply surplus that is emerging. Every report, at least that we see, suggests that there's a lot of momentum coming in terms of LNG supply additions over the next 2 to 3 years. So in that situation, I think from a pricing perspective, Indian consumers should actually benefit both from a pricing power perspective or from a margin perspective, depending on how they actually play it over the next 2 to 3 years.
Okay, all right. Hi, Prabal. Always good to have you on the show in the morning. Prabal, are you estimating any more APM price cuts?
Again, it's a simple formula. It's a 10% slope to Brent. So if you look at $6.4, that translates to a price of around $64 that has been assumed, whichever is the period that the PPAC has assumed. So if crude prices were to soften further, I mean, every dollar typically, theoretically is another 10 cents lower APM price as we go along.
Okay, and what is the volume growth assumptions you have for CNG and PNG growth for the coming year?
I think across the board, what we have seen is that, frankly, Q3 and Q4 both have surprised on the upside. So we have upgraded estimates to at least 10% plus across the board. For all the three companies, obviously, specific estimates differ, but it is between 10 to 12%, at least on the CNG front, that we are assuming. PNG, of course, differs because, you've got industrial and commercial for Gujarat Gas, which is lower, and, you've got a different mix for both IGL and MGL. So IGL is in the range of around 7 to 8% on an overall basis. MGL is probably slightly higher, between 9 to 11%. I'm talking from a 3-year perspective. Gujarat Gas is probably a little bit lower right now because Morbi continues to be a bit subdued at this point of time.
Got that. If LNG prices were to soften further, right, what is the margin cushion city gas companies will have?
I think it's a little bit tricky right now, because you've got to make two assumptions. One is that LNG prices continue to decline in isolation, with liquid fuel prices and Brent prices remaining where they are, because that is really where you can actually eke out margin benefits. What is happening, in fact, in Q4, it was interesting. I don't know if you saw the commentary. The CGDs for the first time mentioned that there was a shift in the refineries back to liquid fuels, which impacted volumes to a certain extent. That's not something that we have seen for a very, very long time, because FO and naphtha prices actually declined to a point where they were competitive against gas. I think as far as margins is concerned, one should sort of remain slightly cautious at this point of time when building in any huge margin improvement per se. I don't think that, that's something that we are really building into our estimates as of now.
All right, Prabal, we're getting into market opening. So a lot on the street will want to know what is Prabal's top picks from your coverage universe. Could you tell us, in that order, the top 3 picks?
I think we continue to remain fairly positive on GAIL, NGL, and Oil India. I think those are the 3 names that we really like. There are other buys, but those would be the 3 names that we would pick, remain buyers of at this point of time.
All right, we leave it there. Prabal, thank you very much for joining us. Quick conversation today. Appreciate it. Well, let's move on and get you the 9-10 calls. Let's go back to Sudarshan. Sudarshan, what do you have?
Well, it's SRF. Buy SRF with a stop under 28.90.
SRF with a stop under 28.90. It's a long call. Mitesh, what do you?
I'll go with the buy on Glenmark for targets of 15.50.
Okay, all right. Mitesh, just wanted to ask you one quick word. United Spirits, any view on how the stock is looking on the charts?
See, I have some positions over there, so very clearly the view will be biased. I think that, the stock price is on the verge of giving a breakout. Waiting for the stock to actually close above these levels of 1600. Yesterday, there was an intraday move about that. Once that happens, you will see that range of 1600 to about 1520 breaking on the upside, and 1700 to thereabouts would be a good target area.
Okay, all right. The stock will be in focus, very small as a percentage of SOTP, but they're the winners, right? So we'll have to keep an eye out with RCB coming in trumps overnight. And as Mitesh said, he's invested in the stock, but he believes on the charts at least, things look a little bit more favorable. Mitesh, we'll come back to you soon. For the time being, hopping across to Ekta to talk about Sun Pharma. Ekta?
Thanks for that. Well, yes, Sun Pharma is in focus because they announced the top-line results from phase 2 trials of SCD-044, which is basically a molecule which is under development. They are trials for psoriasis as well as atopic dermatitis, which they were undertaking. But the drug has not met the primary endpoints in either study. So the development of this particular molecule is now going to be discontinued with no further clinical trials planned. Sun Pharma and Spark are going to be assessing the next steps going forward. This was one of the key molecules in the pipeline, so it's going to be taken as a negative, but it also shines the light on the uncertainty when it comes to R&D, that if in case it is a success, then it's a big win, but if in case it's not, then you can lose out, and all the money that you've spent in terms of trials would then become something which is just a lost investment.
All right, no, absolutely. Ekta, thank you very much for that. Sun in focus today. IEX is the other one. Vivek, take it away.
Well, that's right. So, they've given the operational update as far as the month gone by is concerned. So, electricity trade volumes up almost 14% on a year-on-year basis at 10,946 million units. However, remember, unseasonal rains, early onset of monsoon, like we've been highlighting, has led to lower power demand. And this is something that even IEX volumes are indicating. The company says that this has actually led to reduced electricity demand as well. So, the day-ahead market or the DAM market, that volumes were down almost 20% on a year-on-year basis. However, on the other hand, the real-time electricity market volumes went up by 42%. So, mixed print, and along expected lines, the DAM price was actually down 22% on a year-on-year basis, mainly on the back of the fact that there was much more improved sell-side liquidity. So, overall, a mixed print as far as the month gone by is concerned for IEX.
Okay, all right. Got that, Vivek. Thanks a lot for giving us that take. Mitesh, I wanted to ask you about a couple of these large names. HDFC Bank as well as Reliance Industries. Both those two, remember, they're the large constituent of the Nifty, so they'll have to perform if we need to drive higher from here on. How are they looking on the charts?
In Reliance, I have some futures positions. Disclaimer, there is vested interest. Reliance, has been consolidating post the rally. As long as it's about 1380 odd zones, I think it's good, and I would eventually expect the stock to get past the recent highs of 1460 to about levels of 1500, 1520. HDFC Bank and Kotak Bank, both these big banking names, on the other hand, have turned sideways to mildly negative. I think if HDFC Bank would start getting past 1950-60, then you will see a breakout. Otherwise, you might get it towards the lower end of the range, which is around 1870, 1860.
No, absolutely. By the way, those two names, Spark and IEX, Mitesh, any thoughts?
Spark has something, which has moved up in the last few weeks. There's a big breakout which has taken place. Prashant, the first target was around 200, 203. It's done that and, might see some pullback because the rally has been very good in the last 4 weeks. But in case we start getting past that, I suspect when the upside target will be in excess of 225. While on the chart of IEX, again, the stock has been going through an uptrend. It's met the targets. I am not very sure as to whether it's a good entry point. So maybe if you get it on a pullback, we want to explore a long position.
Mitesh, one of the names which did very well was the big winner last week was Welspun Corp, was up 20-22% Friday to Friday. Yesterday was down 1.5%, not much. Any thoughts here? I mean, I don't know if it's a breakout or how you look at it.
Yeah, I think it's been a good breakout. The earlier swing high was around 880. The stock went right past that in 4 sessions, and yesterday was some kind of a pullback. I think if you get it close to about 900, 885 zones, accumulate, buy more, keep a stop below 850 here, and I think the stock is heading towards 4 digits.
Okay, all right. Let's just quickly run through the market open. Mitesh, thank you very much for being there and running us through your take on individual names. What do we have? I think 18 points lower is where the pre-open is settled. The sensex is settled about 40 points lower. And we are starting about 0.25% higher in the mid-cap index and the small-cap index. It's not a bad start. I mean, given, of course, what the backdrop really has been, of course, and more importantly, the gains that we've had off the lows as well, especially in the broader space. What do we have? First trades coming up. We'll look at the indices. We'll look at the Nifty heat map. Just a quick sort of state of play, and then we'll look at individual stocks. So 24,570 on the Nifty. We're up, barely up, but up. The Nifty Bank is up about 0.25%, 55,740. Sensex is up about 0.25%. Small cap index is up 0.4. The mid cap index, I think, is also starting about 1/3% higher at this point in time. So, I mean, it's an unremarkable open, but it's a positive open. It's a higher start. The heat map should give you a quick sense of how the Nifty 50 stocks are opening, and then we will take it from there. It's all positive. I mean, I think you've got about 30 odd names, not all, but 30 stocks are higher. And you've got about 16, 17 names which are starting in the red. Nigel.
Well, the stocks actually, there are a few of them that are reacting to individual news flows. So, you had Sun Pharma, they have announced the top line results for a phase 2 trial of SCD-044. I think the drug did not meet the primary endpoints in either study. And because of that, you have Spark actually that's pulling back a goodish bit. Spark is actually down close to around 8.5%. So, you should pull that one up for you on the screen. ABFRL, the large trade due, that explains why the stock is down close to 7%. 6.23% equity changes hands. In all probability, Flipkart is likely to be in the seller out there. So that's why, in fact, that stock is lower in trade. What else is moving around? Indegene, well, that stock as well is down close to around 4%, I think. Out there as well, we had a large trade that was due. I think that as well has got cleared out. So keep an eye out on that particular name. On the upside, searching for a few winners since the markets are green, actually. Let's get a few of them up for you on the screen. Not finding any notable one. I think you had Everest Kanto. That one is up close to 3.5%. Lloyd Metal. Yesterday, I think we had Jay Bala who was saying on the charts that stock is looking quite good. After testing around 1,100, well, that's pulling back in style. Up 3.5% as we speak. So big up move is what we're seeing out there. Motilal Oswal actually is doing quite well this morning. Stock is up 3.5%. Volumes as well very, very high for the initial few minutes. And Swiggy is the other name that's sitting with a gain of close to around 3%. Add to the list a Kochi shipyard as well. Good gains on that one. And volumes as well fairly good in today's trading session. Spark is now down 10%. So I think that's calling for attention. And NMDC, the price cut that was actually awaited and the street had a sniff of it, though the management yesterday was non-committal. But that 100-150 rupee price cut is something that the street was working with. That one as well comes up for you the screen with a mild cut of around 1.5%. Tata Tech close to around 750 rupees because of the large trade that was due out there as well.
No, absolutely. And I think we'll have to look at some of this stuff more closely. But I mean, blocks and blocks and blocks. It's just been incredible. The pace at which it's all sort of coming, but also the pace at which it is all being absorbed as well. What do we have? I mean, right now with regards to market, it's still early. I mean, stuff is still opening, but it's positive. I mean, 2:1 in favor of advances is what we have. The number one volume-led gainer on the Nifty is Motilal Oswal. It's up 4%, and it's got twice the volumes on the NSE compared to the second largest volume-led gainer. Shipbuilders, once again a theme, and they always move in a pair or, like triplets. But Garden Reach and Cochin are the two names which are moving higher at this point in time. Garden Reach is up 5.5%. Cochin is up about 2.5%. Radico, I'm not sure we highlighted. Radico is up 4%. That's a pop, straight up. 2,800 on Radico, and it's got very large volumes, 140,000 shares right now, right at the word go. There is Premier Explosives, which is up about 5% as well. I can spot Hitachi, which is up about 2%, and there is Jubilant Food, which is up about 3% or so. And there's Techno Electric, which of course has done very well from the recent lows of about $1,000. Stocks at about 1,500. Policy Bazaar and Genus Power and Torrent Power. But then volumes start to fade off very, very fast as you kind of go down the list. The two biggest volume-led losers, as Nigel mentioned, of course, are stuff where there are blocks.
Yeah, just one point on Motilal Oswal. The reason of that volume spike is 0.5% equity has changed hands. We'll have to check out who exactly with the parties. But for the time being, that explains the big volume surge that we're seeing. And a couple of other names, the Anil Ambani Group stocks, Reliance Power as well as Reliance Infra. Last 10 days or so, we have had massive volume action. Yesterday, it ended lower, both those two stocks. today as well, very, very large volumes for the first few minutes. Both the stocks mildly higher.
I mean, they're back in that sense, right? I mean, the stocks have done phenomenally well, both these names, Reliance Power and Reliance Infra as well. Well, let's welcome in Amish Shah. He's head of India research at BofA Securities. Amish joins us from the sidelines of the BofA Securities 2025 India Conference. Amish, good morning. Great to have you here. Prashant this side. We spoke to you when the conference was starting, so let's do a little bit of then and now. Although the then and now are only separated by 3 days. So what are the one or two things which really stood out to you from the conference in terms of takeaways from all the conversations you've had and sort of made you sit up and take note of in terms of what was happening?
Sure. Good morning. Thank you, Prashant. So look, I guess there is definitely optimism within, across all sectors, amongst all companies. But at the same time, they are quite measured. So I think the message that we've got is that everybody's cautiously optimistic. The other trend that we've picked up is a majority of the companies are talking about how there might be a slow start to the first half of this fiscal, but most of them are expecting it to accelerate in the second half as we go along. So sector after sector, we heard it from IT, we heard that from consumer, from autos, from banks. So I guess the mood is that once the geopolitical and global macro issues get more clarity, there will be more growth visibility as we go along in the second half.
All right. Hi, Amish. Good morning and good to see you, Ben. What about, the biggest concerns with regard to the Indian markets? Flows seem to be good. Earnings are yet to catch up, but if you could highlight, a couple of concerns that your interactions with a lot of the investment community did throw up.
So, Nigel, I think the concern is that versus what the companies have already guided, at the margin, the tone is getting a bit more cautious, or companies are highlighting more risk factors or factors that they are watching out before the companies themselves get clarity. I'll give you some examples. So auto companies, for instance, are talking about rural markets recovering, but at the same time, growth in the urban markets peaking off. If you talk to IT companies, they are talking about, slightly better than what they expected in terms of spends on cost takeout programs. So they are getting more deals, but yet they believe that till the time US-China trade issues are not sorted, their customers in the US are not able to make the full tech budget decisions, because US-China trade deal is absolutely an indicator that the trade wars are behind us. So IT is waiting out for that. Banks, they know that the NIMs will compress on the back of rate cuts that are going through. And loan growth generally is not that, June quarter is not the best quarter for loan growth. So they're expecting an acceleration. But do you grow in unsecured, where there could be pain points in terms of NPAs later? If you try to grow in secured category, the NIMs are quite low in terms of mortgages, etc. So I guess, even the corporates are right now trying to figure out, on absolute all factors. They don't have clarity on all factors right now. So there is a bound of this cautiousness that they are highlighting, which is also keeping the investors a bit confused on whether should you go whole hog or do you wait out for the clarity to emerge. So I guess those are at the margin some concerns right now.
On the banking space, that's going to be interesting because everyone's waiting for a rate cut. But in the near term, actually, rate cuts will put pressure on the margins. And as you said, the loan growth is still being quite anemic. Are investors prepared to look ahead? Because as things progress, the first hit comes on the loan rates. And later on, in fact, the deposit rates as well will cool off. So ultimately, the NIMs will look good in the longer duration. In the near term, in fact, there'll be that headwind. Are investors willing to look ahead? And suddenly, in the last month or so, these PSU banks, they have come back into play. Is there a lot of interest for PSU banking names?
So Nigel, first of all, financials is at least a sector that unanimously everybody likes, including us. But then the answer to your question really depends on my investment horizon. So if I'm an investor who's mostly a hedge fund and cares for near-term triggers, they are not that excited about financials as of now, because they do think that loan growth revival will take some time, but the NIM compression will be in the here and now. So you're first looking at a downprint, and then you're going to look at an acceleration. But the long only investors are basically waiting if there were a correction on the back of that, because they want to, as you said, they want to look ahead and they want to use this dip as a buying opportunity. In context of the banks within private and SOEs, etc., I would say that again, that depends on how much risk you want to add to your portfolio. So if I'm an investor who's happy with steady returns but a safe stock, then I still want to be invested in the top 2 or 3 private sector banks. But obviously, if I want to add beta to my portfolio and I don't mind taking a little bit of more risk, but I want higher returns, then SOE banks are definitely finding favor because they're at least valuations for SOE banks, as we know, is quite cheap. A lot of them are still trading below 1-time book. So the expectation is that when the cycle turns, it will be favorable for all banks, and cheaper banks should therefore give you higher returns.
No, absolutely. Amish, there are so many, in a way, and India, the beautiful thing about, of course, the market here is it's not concentrated in one segment, right? And I think that's a point that you've made before as well. And global investors appreciate it. It's not metals heavy or tech heavy like many of the regional markets are. So you really have a buffet of stuff and a big one. But incrementally, I'm keeping aside some of the older legacy sectors, which are the sort of newer areas where investors are really looking for ideas in. And in these new areas, there are lots of sort of companies making it to the market with IPOs, etc. as well. So just give us a tease about that, 2, 3 sort of newer segments in that sense.
So Prashant, actually there are plenty. You're very right. India clearly has a lot of opportunities, and a lot of interesting companies are now getting listed in a variety of sectors that we were earlier not looking for. So I think valuations aside, but sectors that really excite investors right now is EMS, semiconductors, biofuels, green hydrogen, data centers, travel and tourism. So clearly there is a variety of things to choose from. In fact, even in the consumer durable space, there are some interesting listings that are expected. So that space is expected to go wider. Every time that you hear about an industry body talk about manufacturing, electronics is only expanding as an ecosystem. It started with mobiles. Now it's being expected that it will roll over to consumer durables, and it is expected to go to tech hardware, and then semiconductors comes in by that time, gives you visibility. So there is definitely traction to all of these themes. In some cases, valuations though may not be to your comfort.
Okay, all right. Amish, post this run that we have seen, and when we went to around the 22,000 mark, you all were quite positive. Now, do you think for the remainder of this year, fixed investment bonds, they will offer better returns in comparison to the Indian headline equity market?
I would say so, Nigel. On a fixed income product, you can make about 7% pre-tax, but that is definitely in the bag. Whereas for the Nifty, as you know, our target for this year is 25,000. We are only about a percentage away from there. So clearly the conviction that markets could give me even a high single-digit return is not very high. So if I can get a safer return in a fixed income product, then I would probably look to avoid the risk of equities right now. And when I go to the broader markets, there, as you know, our views have been negative. Because we think that large caps are still sensibly priced or fairly priced, but the mid caps are actually quite excessively priced. So I would say that if you're a patient investor, you may want to step aside, get into fixed income for some time, look for markets to get cheaper, and then equities, obviously, in India from a long-term perspective, is definitely going to outperform debt over long term.
Okay. All right.
No, absolutely. And I think those are important points there that you make. Amish, thank you very much for joining us. It's a pleasure having you here on CNBC-TV18, and look forward to our next conversation. Thanks indeed. So that is Amish from the sidelines of the BofA Securities 2025 India Conference. Let's just take a quick look at the market. We're up 40 points, 24,580 is where we're at. And yeah, I mean, it's still holding and holding on very, very well. Lots of new stuff in the mix. By the way, and we should put these stocks up at the bottom of the screen, the three biggest volume-led gainers actually are shipbuilders. The top 5 volume-led gainers across the NSE are defense companies. So if you can have Garden Reach up, I'll just quickly run through these. 8% higher on Garden Reach. It's a new all-time high. So there you go. Let's look at Cochin Shipyard, 4.5% on Cochin, 2125. Almost a new all-time high. The all-time high on this one is about 21.95. It's at about 21.24. Mazgaon Dock is up to about 2.5%, 35.31 on this one. BDL, that is Bharat Dynamics, is up 3%. BEML is up about 3% as well. And which basically means that it'll all show up on the Nifty Defense Index. I think should be up at least 2%, if not more. And we look at that as well. But there is so much more stuff which is starting to come up and show up. Almost 2% there, 89.45. So really the sector of the day so far. Nifty is cooled off a little bit. We're still up about 25 points or so. Cement, Nigel, is in focus with the Jefferies view, isn't it?
Well, that's right. You know, Jefferies is pointing out that actually in the past quarter, that's quarter 4, there was an improvement that they saw in profitability. So they say that, in fact, there's a strong rebound that you're seeing in quarter 4. Remember, the previous few quarters was a little bit subdued. So they point out that quarter 4 EBITDA growth was in the vicinity of close to around 11%. That's on a year-on-year basis. Keep in mind, pricing was still weak, but yet they delivered a EBITDA growth of 11%. And on a sequential basis, it was beautiful. It was a 60% recovery because quarter 3 was an absolute washout. How did they manage that? There was a recovery in pricing, and there was more or less steady volume growth because, you know, you're not off to the races with high single-digit, but mid-single-digit growth is what most companies delivered. They go on to point that quarter 1 could be better, particularly for the segment of the market that delivered awful numbers. That was a South industry. Because of their price increases didn't really fructify. But now price increases are coming about. So quarter 1 could be far better. They say that they're expecting the sector, cement sector on the whole, to turn around in FY26. And in terms of their top picks, they're pointing out that Ultratech, Shree Cement, as well as JK Cement, all of them are the top picks in that space. But I think, Prashant, you were talking about shipbuilders. Let's stick to that theme. Let's talk about shipping, another ancillary out there.
No, absolutely. And, it's an industry which is, of course, it's got its own ebb and flow, but I think there is also a lot happening on the global side with regards to sort of conflicts. Always comes up as a sector to look at from a broader perspective as well. Let's focus on the space now. And Trump's tariff trade war is, of course, getting more entrenched, if anything. The good news seems to be behind, and now we are, I guess, entering a bit of a more tougher sort of a space. Remember, those 50% tariffs on steel and aluminum go into effect. That order has been signed. And there was that Wall Street Journal report which said that China wants to play hardball. They're not going to sort of lay down and let the Trump administration do what it wants. So a more tougher, contentious kind of phase with regards to what's going on here. We have Mr. Shiv Kumar. He's Executive Director and CFO at GE Shipping. He's with us now to take some questions. Mr. Shiv Kumar, good to have you with us here. Thank you very much for your time. I just wanted to, before I get down to GE Shipping, I just wanted to get a quick sense on, some of the bigger stuff. From the last time we spoke, have things changed in any which way? Also weigh in on the steel and aluminum tariffs. Will that make a big difference to the shipping business, the bulk business?
Yeah, morning, Prashant. Thanks for having me. Not much significant change on the commodity trade from the tariffs from the last time we spoke. Steel could be affected. Yes, again, it's a small part of commodity transportation, especially steel into the US. It's not a huge amount. Remember that the overall dry bulk trade is 5.5 billion tons. So it's not a large part of the trade. Aluminium also not a huge part of the trade. We have bauxite, which moves a lot, alumina in a smaller way. But again, unlikely to be affected in a big way here. So not much on the commodities front from this latest round of tariffs. Really.
Not of course, not from an India perspective, but I mean, your business is global, Mr. Shivkumar. Even there, not very much in that sense?
Not really. The steel trade is not a very large part, especially the US imports, not much at all. In fact, even Chinese exports of steel are pretty low, if less than 1% of overall overall dry bulk trade.
All right. Hi, Mr. Subkumar. Good morning and good to see you again. So you're basically, if I got that correct, you're saying demand hasn't got hurt by this additional round of tariffs. Is that correct?
Yeah. So it's unlikely to have a big impact. Demand probably gets hurt. I'm just saying it's not going to be significant because it's a very small part of the commodity trade overall.
No, this aside, I'm saying for you, demand on the whole, are you seeing some kind of a slowdown in terms of movement, in terms of conversations that you're having? Leave this aside with regard to the smaller part, steel as well as aluminium. But on the whole, dry bulk, is there a slowdown?
Yes, there is. There is one specific trade which is affected by the tariffs, which is the US-China grain trade, because China has put tariffs on US grain as well. So that has slowed down significantly while the importers wait for the outcome of whatever talks are happening between the US and China. So that trade has slowed down significantly. But otherwise, there is not really anything much. I think I'd mentioned the last time I was here that the LPG trade also is affected by this because there's a lot of LPG, specifically propane, going from the US to China. That again has it slowed down a bit, but I think the trade has rerouted and it's sort of adjusted now.
You know, Mr. Shivkumar, we've been having these conversations with global trade economists, etc. You must have seen the OECD forecast as well, growth forecast, sharp cuts. I spoke with the Morgan Stanley global chief economist, right? I mean, they're all expecting, you know, the markets, of course, when I say markets, I mean stock markets. They're not reflecting it, but they're all expecting a pretty sharp slowdown in the US and as a consequence of it for global growth as well later this year.
Yeah, while we're not seeing specifically tariff-related issues, we are seeing maybe some impacts on overall growth. The oil trade has been pretty weak. We're already seeing revisions in oil demand growth numbers for forecast for 25 over 24. We are seeing iron ore, coal trade also being weak. Again, those are driven, iron ore is driven in a big way by Chinese steel production. Coal is driven in a big way by Chinese imports and by Indian imports. And again, domestic production in both of these countries also affects it. But in general, I would tend to agree. The oil demand has been lackluster. The demand growth has been lackluster. So there does seem to be some underlying pressure on the macro.
Got it. Okay. All right. Let's talk about pricing then, sir. Could you tell us, for the various segments that you operate in, what has been the pricing change? Say if you compare the Q1 average with what we saw in Q4 or with Q3, how has the trend moved?
As it stands, it's not very different. Again, I'd like to add here that this is traditionally a weaker period for tankers because tankers typically have a strong winter and a weaker summer period. Again, we did not have a strong winter. So markets are marginally weaker in some sectors for tankers. But in general, I would say we're about the same as we were in Q4 FY25 because Q4 itself was not a very strong quarter. Dry bulk, again, is the opposite of tankers in seasonality. Typically for them, Jan-March is the weakest quarter and it starts recovering. So we are seeing a little bit of a recovery in dry bulk rates, but not a huge amount. So it's much of a muchness, really, if you take the entire fleet. Not very different from Q4 FY25 as it stands today.
Okay, got it. All right. Let's talk about the smaller part of your business, the offshore business. How has the pricing trends been out there with regard to rigs? How many of them have already been repriced? How many of them are due for repricing? And what is the rough change out there? I recall a few years ago, Mr. Shivkumar, when you used to come, we used to talk about how that business is turning around. It turned around a little bit in the middle, but I want to know what's the recent trends in terms of pricing?
Yeah, so that the story for the last 15 months is that there's been a significant setback. Saudi Aramco off-hired, I think, 24 rigs in the last year or 15 months, which has had a big change in a big impact on the sentiment overall for the jackup rig business. So we had one pricing for a 3-year contract in India. for a rig which is coming off her previous contract, the end of calendar 25. That pricing from the last pricing we had for a similar contract in India was in end of 2023, before the Saudi Aramco actions. So that pricing is probably down more than 50% on a day rate basis. And again, this is what happens in tender pressures, where the number of bidders is more than the number of rigs which have been asked for, and where you have to be L1 in order to get the contract, and you have to match L1. So pricing has come down a lot. It's still positive on EBITDA and significantly positive on EBITDA, but it's a huge drop in pricing. So to that extent, the rates are down. We also have 2 rigs which have got short-term contracts. So one is a 4-month contract, one is a 6 to 7-month contract. These are the minimum periods, both of which will go onto contracts by the end of calendar 25. So we chose to keep 2 of them on short-term contracts because we were not very happy with the long-term rates. The short-term rates, of course, are significantly higher than the 3-year contract that we've got.
So how much higher are they, sir?
They're probably 50 to 60% higher than the long-term rates.
Okay, the short-term one. And the long-term rates you said are how much lower?
About 50%, more than 50% lower from the pricing of calendar 23, end of 23.
Got it. All right, Mr. Shivkumar, we appreciate you joining in. Looking forward to chatting up with you, maybe post the conclusion of the Q1 results. But thanks a lot for giving us some color on how you see the industry panning out from here on. Well, for the markets on the whole, while we're having that chat with Mr. Shivkumar, well, we had the Nifty Bank. That one has dipped a little bit. I think now it's closer to around, moving a little closer to the 20 DMA, which is the important mark. The last few sessions, actually, what's happened is some of these private banks, they have been doing a relative underperformance. But as Prashant said, the likes of Garden Reach, Kochi Shipyard, well, they are on fire. Those stocks are doing a thing of their own. We slip into a short break, come back. We'll be joined by the management of Mastech to talk about the quarter gone by and the outlook going forward. Stay with us. Welcome back. Markets more or less flattish as we speak. The Nifty at least has flattened out, and the advanced decline ratio, which started firmly in favor of the number of stocks that are advancing, those lines are getting closer. They're going to be kissing each other soon, I think so. It's almost pretty much even Stevens. The crisscross lines should come up for you on the screen. But this is Corporate Radar, so let's invite our next corporate on the show. We have Mastech. They announced their fourth quarter's numbers, which beat estimates, although margins were a little bit under pressure. But what's the way ahead? Mr. Desai, the Vice Chairman and the Managing Director at Mastech, joins us on the show. Hi, Mr. Desai. Good morning. Good to see you in, as always. Thanks a lot for joining in. Well, let's talk about business, how things are shaping up. NHS revenue first. What was the contribution in FY25? And what's it going to look like in FY26?
See, revenue growth, as you know, for FY25 has been around 14% year on year. That means annual revenue growth, Nigel. So the whole thing was, this is much better than industry, as you know. Industry did grow much lesser than that.
Mr. Desai, I was asking, what is the NHS contribution in the past year?
We don't have a contribution like that, each customer-wise. But healthcare together account for a fairly large percentage, close to 20%. And that includes, of course, NHS and other US healthcare providers that we work with. And that's a focus area that we have. It is next to our government and education sector.
Got it. All right. Just to get some more color on NHS, it's been around 3 months since NHS was abolished. Any spending cuts that you have observed?
No. In fact, in NHS, we have been very happy that some of our old projects, Nigel, which were actually under some kind of suspense due to a lot of changes that were happening over the last 2 years, which did affect us, as you know, have now started moving ahead. and we are booking orders as we speak. So we have not seen much impact, if you look at it that way, from these changes in NHS, because there's an existing commitment that NHS has made in terms of our backlog, in terms of the work that we do, and more work that they want to do.
Okay, all right, got that. Give us a broad idea, sir, qualitatively at least, how quarter one has been so far. Now, in quarter four, there was plenty of uncertainty, right? Yet you grew by 2.9% quarter on quarter, which the street liked quite a bit. Many other of your peers, they reported a decline. So, as things stands in quarter one, how are things panning out?
I would not like to speak specifically on quarter now that we are almost very close to the quarter. So I would focus generally saying what has been our focus area, Nigel. We are focusing on, of course, in our UK market, government, SGS as we call it, which is growing very fast. We have booked a lot of new orders. In fact, some of the orders were just booked post our results announcement, which we announced very early, as you know. And as you asked me about NHS and healthcare, these two sectors are doing it well for us across the countries that we are speaking about. We always like to target, and we have done that over the last 4 or 5 years, as you know. I have grown faster than the industry in terms of our revenue growth. And we would like to move in that direction during this year too. And I think we are well focused to reach that given our strategy.
Okay, let's focus. Mr. Desai, we won't push you. We don't want a quarterly number. Let's talk about the year. Last year you grew in double digits. This year, is it possible?
As I said, we would like to do faster than the industry. So I would like to definitely say that we would do better. You see, there is an uncertainty, you must realize, in terms of US-related issues. We all know that well. And how it pans out in second quarter, we have to see in terms of its impact on the market. So I would, at this point of time, not make any specific statements other than saying that we have a momentum. We are doing better than industry. We did it last year as I told you, even compared to the overall mid-cap domain.
Yeah.
Yes. We would hope to do that this year too.
But what will drive growth? Because I think UK is around 60% of your revenues. US, as you said, things are uncertain. But, at some point of time, post this uncertainty, US as well could pick up, right? So how do you see geography-wise things pan out?
See, we have invested substantially in the tomorrow's technology. That's point one, which is about AI and data. Internally, in terms of improving productivity, and externally, in terms of acquiring a company that we acquired, which focused on data particularly. Now, there is no kind of slowing down in that part of the business anywhere in the world, UK as well as US. In fact, we have booked fairly large orders in data-related issues all over this quarter as we speak. So that is one driving engine that we feel good about in terms of growing. That's one. Number two, we have invested substantially last quarter. Some of it got reflected in terms of our profitability, as you told Nigel. He is going to give us benefits in terms of growing in the existing market. Please remember, we have close to 100 plus active customers in US, for example.
Yeah.
And these customers are there with us for last 4 or 5 years, some of them, of course, we have added last year. But each of these 120 customers are an expansion for us, particularly those who are in Fortune 500 and Fortune 1000 area. And given our focus, particularly in healthcare and data and AI, that we are training people, we have trained almost 70-80% on AI. We are focused with some projects in AI. I will not take all the names here. I feel confident that we are at the cutting edge in terms of the revenue side of it. And yes, we have to watch uncertainty that, of course, we have to be cautious about. We can't just be, ignorant about it. We have to plan, and we are constantly working inside to see how, if at all, we have to refocus or re-strategize and improve our control on the operations in the light of things that are unfolding. And I feel confident, given our new management, we have a CEO, as you know, and our board, we will be confident, Nigel.
All right, sir. Sir, it's good to hear, because that data, AI, that's the buzzword, right? And that's the entire focus out there. And as you said, no slowdown out there. In fact, that's the path ahead. As a percentage of your revenue mix, how much comes in from these segments?
See, presently it is below 10% as a data. And we feel that that is, again, a kind of indicator for us in terms of much more that we can do. And that, as I said, is a growth engine, and we feel confident that we can do that.
Okay, and as both these two verticals scale up as well, I understand that they are margin dilutive, at least in the near term. But still, you're confident that margins will improve this year to the 17 to 19%?
We don't want to make exact statement. That is a direction that we are moving. We want to move back to that number that we had. And last year has not been high in terms of that number. But we have spent that time in investing. And this year also, obviously, we would like to invest in future. But we would definitely like to improve what we have done over last year. That we are very confident as an overall year, because there has been a focus on improving profitability in-house. We have task forces, we have top management working on specific areas. So I'm very confident that we will do better in terms of profitability than last year's number and move towards the number that you are talking.
But Mr. Desai, we can't let you go at that. At least margin band 17 to 19% is an aspiration?
Yes, of course it is an aspiration.
Got it.
Of course
all right. And
we would like to achieve as close to as possible. But as I said, we are moving in that direction, and we would like to do better than what we promised.
All right, 17 to 19%. When you join us at the end of quarter one numbers, maybe we'll push you a little bit more. Lower end of the...
I said not 19%.
not right now, sir. Not right now.
19%. I said we are moving in that direction. and we would like to see whether we can reach that band as soon as possible for the whole year. I don't want to make any prediction on this quarter, right?
Okay.
I'm talking of the whole year.
Okay, all right. And cash of 600 crores in your kitty, it helps at these kind of times.
Sure.
What do you plan on doing with it?
See, as of now, we would like to digest the acquisitions that we have done, Nigel. As you know, we have done 4 big acquisitions over the last 5-6 years. And we are just taking a halt right now and looking at what we can do moving forward. We, of course, have to look at our cash flow and see how we can utilize it the best. But as I always said, we are open, but at the same time, we are not accelerating. We are focusing on our existing operations and how we can move it ahead. If anything comes up, obviously, like any other thing, we are all open. But that's not, we are moving in that direction, that at a high speed.
All right, Mr. Desai, we appreciate you joining in. Thanks a lot for giving us some color. And at the end of quarter one, maybe we'll press you a little bit more for numbers. But as you said, situation's a little bit uncertain out there. You're optimistic on outbeating the industry with regard to growth. Your aspiration is to improve margins, and you're sitting on some cash as well in your books. Thanks a lot, sir, for joining in.
Absolutely, and interesting conversation there. By the way, markets, of course, are absolutely flat, 24,550, just about 8 points on it at this stage. Let's talk about another company, and this is MapMyIndia, or CE Infosystems. There was an analyst meet a few days ago, and the company's set an ambitious target, 30% revenue CAGR over the next 3 years. And of course, a strong margin guidance, etc. as well. We have Rakesh Verma, co-founder and chairman and managing director at MapMyIndia, who's joining us. Thank you very much, sir. Good morning. Prashant this side. Always good to see you. So you've retained that 1,000 crore top-line guidance by FY28. You did about 460 odd crores in FY25. So 3 years out, 30% CAGR. But if I look at what you've said your order book will be by FY28, that's about, you're saying, actually you said it will be in excess of 2,000 crores. That kind of indicates, a much slower rate of growth in that sense. So is there a bit of a disconnect here? If you can sort of start by answering that, are you going to rely on short cycle projects? Does this include some inorganic acquisitions, etc. as well?
It's not a disconnect. It's the nature of the order that comes every year. So at the end of every year, we analyze, is it the open orders are going to be executed over 4 years, 5 years, 3 years, 2 years? It's different types of orders because, we are in mass, PaaS and SaaS business. So when we look at this current open order, we believe that it will get consumed in something like a 3-year cycle. So it's that. So when we say 2,000 plus at the end of 5 years, it's not short term, but it is the way, the nature of business that's happening. All the orders are not 5 to 7 years contract. Some of the orders are even 1 year contract.
Right. No, and I completely understand. That's perfectly reasonable explanation, Mr. Verma. Now, let's just talk about where the growth will come from. I mean, you already have a 90% share in automotive navigation. So the growth largely is about how fast the industry will grow. In terms of market share gains, there is only so much now you can do in that sense, in this segment at least. So just talk to us about that.
Well, 90% of the domestic market, right? Now, as you know, we have expanded to Southeast Asia in the automotive sector. The Southeast Asian market is as big as the Indian automotive market, almost same 4+ million vehicles every year. So now that has opened up a new opportunity totally from zero. And we have started earning revenue already. So that, and I'm not saying that we'll achieve 90% in the Southeast Asian market, but we have given a projection already in the analyst meet that from a 26 crore in FY26 to 80 crores or so in FY28 coming from so that's one part of the explanation. From the domestic market itself, the penetration is increasing. The penetration increase irrespective of the industry growth, which you may take it as 3-5%, right? That's what I guess everybody's expecting in the industry. The penetration increase itself is going to increase. Thirdly, the upselling in terms of the autonomy or autonomous vehicles has started with an ADAS 2 already, and we are looking at ADAS 2.5 happening in the next 3 years. All put together gives us a very good picture of automotive sector of our business.
All right. Hi, Mr. Verma. Good morning and good to see you in. This is Nigel on this side. I just want to focus on your segmental breakup. Your auto and mobility segment, that grew by what, around 13-14% in FY25. So in this segment, is this the kind of growth trajectory we should work with, say, for the next 2 to around 3 years? So that's about that segment. And this 30% growth CAGR that you're talking about over the next few years, that will have to be largely led by consumer tech as well as enterprise segment. Is that a fair assumption? A&M grows at, low teens, low to mid-teens, and the other segment grows, C&E grows at a faster clip?
Not really. Certainly that other sector might grow at a faster pace, but let me give the explanation in another way.
Yes.
As per where we informed in the analyst meet also, we have informed the stock exchange also, the company has been reorganized. With automotive and corporate, enterprise has two parts. What you used to call C&E, consumer tech, think of that, corporate. So the automotive and corporate is now going to be part of the parent company itself. So the growth which you were talking about, 13-14%, now the parent company growth has to be looked at, not 13-14, but much more. That's part one. The other business is the government business, which is what we call it as Mapple's Digital Transformation Company and IoT. That has another growth opportunity. Now, the growth if you look at purely growth, the opportunities in the government and IoT is much, much larger than the automotive and enterprise. But automotive and enterprise brings in a much, much higher margin. So it's a very good combination of the two that we are looking at and going to be operating in two different ways of how to make sure that we achieve the 30% growth overall and we achieve 35% plus EBITDA.
The reason I asked you, sir, was because the A&M as well as the CNDA, they were almost going at a similar run rate. And suddenly the CND now has taken off. It's doing a quarterly run rate of around 90 crores. But we got your point in terms of, the way you see the business pan out. Overall, blended, you're expecting 30% CAGR growth. Got that. Now, let's talk about your fixed pricing contracts. I think they made up more than 60% of your overall new orders, if I got that number correct. In the previous year, it was close to around 30%. So, while the volume-based, well, that's gone down. So, fixed contracts, price contracts has moved up. Can you shed some more light on this sort of a shift?
Again, as I said, every year and we look at what contracts we have gotten. And based on that, we are able to say whether we'll consume the open order in 3 years, 2 years, 5 years, or whatever. Coming to that fixed price, yes, last year we entered into many fixed price contracts. As a matter of fact, strategically, in some ways, with certain types of customers, fixed price contract is beneficial to us because we have a very predictable revenue coming from that.
All right. One final question, Mr. Verma, before we let you go. Since defense is the buzzword, can you elaborate on that potential use cases of drones in the defense sector and also your partnership with the DRDO?
Well, to the extent I can share with you, we are primarily into the software aspect of the defense sector.
Yes.
And we are doing lots of projects with them on that front. For us, it's not a buzzword. For us, it's a straight business.
For the market, sir, it's a buzzword, sir. For the market I refer to, it's a buzzword. For you, please explain to us how you see business panning out. Please go ahead.
See, with the kind of technologies we have, which we use in the consumer tech or enterprise or automotive, the nature of business with the government doesn't change as far as we are concerned. It's fundamentally a software-driven, the kind of technology we have developed and we are developing in the drone sector, as you said, is being used by the government, and government means defense, and will be used more and more as the time comes.
Right. Mr. Verma, one last question before we wrap things up. How much of your time is spent on worrying about whether some new around-the-block startup is going to disrupt your business, especially using AI, open source? I mean, I was reading this piece about, I think it's called, there's a company called OpenStreet Platforms, which is now trying to do this. Using machine learning, AI, etc., to provide real-time updates. I think you also have started something called Clarity X, if I'm not mistaken. So you're trying to do all of that, but is it a risk at all for investors?
No, let's keep Clarity X on the side. First part is what you said, the OpenStreet, AI, and all that. MapMania has been doing this kind of an AI-based map updation or creation, and moving towards even ADAS 2+ now. It has been part of our, not today, but part of the last many, many years. Now, coming to the competition, how much time I spend or we spend, I tell you, we take it as a noise, not that we don't take noise seriously, but we have seen the noise over the last 20 years. So we are now a lot matured on how to separate out the noise versus something real. We don't see anything real as of today.
Okay, all right. So your eyes and ears are open in that sense. Yes. Point taken. I mean, you were in a world where Google searches have fallen for the first time in 20 years because of platforms like Perplexity. So sometimes nothing happens for 20 years and suddenly things change. Thank you very much, Mr. Verma. Appreciate you joining us. Good speaking with you, and I think provides a fair bit of perspective on the business for investors. We'll take a quick commercial break here. We're going to come back and we'll have Manisha join us on the other side with a focus on commodities. Stay tuned. Coming up. Okay, welcome back. Markets are up about 40 points, so not a bad day. Market breadth is now 1:1. It's evened out. Let's focus on some stocks. Vivek is here with some blocks which have happened and which are likely to happen. Vivek, take it away.
Well, that's right. So we had indicated about 4 blocks that will happen in today's trading session, and within the first hour itself, all of them have happened. A couple of them were pointed out by our colleague Nimesh, and along expected lines. The first one is AB Fashion. Remember, this is the demerged entity, Flipkart, that held a little over 6% stake in the company, completely has exited its stake as per the term sheet that we accessed last evening. So this particular deal, equity over 600 crores actually changed hands. The second stock, it's a very large portion of the equity, almost 1/10 of the percent equity of the company changing hands. So Carlyle today, as per the term sheet that we accessed last evening, has completely exited its stake as far as the software pharma company, that is Indegene, is concerned. Again, over 10% equity changing hands, 1,500 crore worth of equity is what has got absorbed. The other stock was Tata Technologies. Again, over here, remember, TPG, that held 6% stake in the company at the end of the March quarter, remember, had exited close to 4.9% equity in the month of April. And today it was a clean out trade from Tata Tech. Over 2% equity they've sold. So now they don't hold any stake in Tata Technology, post today's block deal. And lastly, Alkem Black, a promoter, continues to trim stake. A promoter by the name of Jayanti Sinha today exited close to 1.4% stake. And again, this was done via the block deal window itself.
All right, Vivek, thank you very much for that. So that's blocks in focus. Let's focus on Spark as well, which opened about 5.5% lower. Ekta with more. Ekta.
Thanks for that. Well, yes, Sun Pharma and Spark are in focus because Sun Pharma and Spark have announced that the top-line results from a phase 2 trial of one of the molecules under development, SCD-044, has not been successful. So, for example, this particular trial was for psoriasis as well as atopic dermatitis. It has not met the primary endpoints in either of the studies, for psoriasis or for dermatitis. Now, the development is being discontinued and there are no further clinical trials which are planned. Sun Pharma and Spark are going to assess what next steps to take. This is a negative because it was considered to be one of the key assets in the company's specialty pipeline, that's Sun's specialty pipeline. But as you can see, there's a drastic difference in terms of the stock reaction between Sun and Spark, because this definitely means more to Spark, considering that they were doing the R&D for this particular molecule. The stock has, the stock has actually corrected quite significantly already from its 52-week high. It's down around 35%, but its 52-week low was at around 100 odd rupees. So people were waiting by for this data to come through with regards to this particular molecule, which was expected now, right about now, and hence it's been a disappointment. And that means that Spark will probably have one of the bigger molecules lost in its pipeline. That's the current update. We'll have to wait and see what the future pipeline of molecules looks like for Spark. As of now, disappointment.
All right, thank you very much, Ekta, for that. It's a very sharp cut coming through. Well, let's shift focus to the commodity space now. Manisha is here with what's top of mind. Manisha, good morning.
Morning, Prashant. I'm looking at the silver prices because while there's quite a bit of a volatility across board, but silver seems to be holding around that 34.5 kind of levels, which is near 7-month highs that we've seen for prices. And silver, for the very near term, seems to be outperforming gold as well. It's gained 5% in the matter of last 1 week. It's up 7% in a month. It's up 21.5% in the last year. And this year so far has gained up by nearly 20% as well. Well, there's a lot of support coming in for silver. One, of course, it is because of the safe haven buying. We are looking at various geopolitical tensions, slowdown concerns as well. The weak economic data that we seem to be looking at from Europe, from China and US as well, especially China, where we are looking at weaker numbers, is what really has led to silver buying there. The markets also are anticipating that we could be looking at the US Fed interest rate cuts in the month of September. There's almost a 75% probability of that is what the street is working with. And then the silver usage in EVs, electronics, AI and data centers, healthcare application really seems to be expanding. Well, just to give you a sense of number, the modern solar panels use 120% more silver per kilowatt versus the older models. And that is what really seems to be working right now. And that is what the markets are doing in sense of a calculation. The photovoltaic sector also accounts to nearly 15% right now of the global silver consumption. Well, we've seen those numbers continue to increase as well. And then industrial applications and fabrications at this point account for 55% 25% of total silver demand, and 45% is used in sense of investment, jewelry, artifacts, etc. Much of that clearly coming in from Asia. Some more numbers on your screens, and that should tell you on the industrial demand. Last year was a fourth straight year of record industrial demand for silver at 680 million ounces. And this year it's anticipated even higher, a fifth record year, by the way, at 700 million ounces. And also when you look at the global silver estimates, we are looking at a production of 850 million ounces, while a demand is anticipated at 1 billion ounces. 2025 is also going to be a fifth straight year of global deficit when it comes to silver, and markets do anticipate that silver will continue to outperform gold in the coming couple of years as well.
All right. Well, thanks very much, Manisha. So precious metals, gold, sometimes silver now, as Manisha points out. Well, we'll take a quick commercial break here. Our special segment, it's the economy on the other side. Lata will be speaking with Chetan Iyer, Morgan Stanley on tariffs, the RBI policy and more. Stay tuned.